So now following on what we talked about with some of the worsening, or really, I should say, the issues remaining pretty consistent on some of the delivery delays, we want to look at some of the data and leading indicators because you're starting to get some benefit coming forward. So when you look at the U.S. Citi Economic Surprise Index on the hard data, you can see that there's been a nice recovery where we were bumping along the bottom, but now some of the leading indicators are starting to improve. And this is what we were expecting on a seasonal basis. This is why when we were never really concerned in the near term on a recession or some big deflationary push, because the data was going to improve. There's nothing, as my old boss used to say, nothing dies in a straight line. So you're going to get a bounce. You're going to get some of this recovery. People still need to build inventories. You still had a lot of backlog and orders. So there was something to help provide some of this bump. And here's where we're starting to get some of these increases. But it's not everywhere. And that's one of the things that we want to look at. Where are we seeing improvement? Where are we seeing some slowdowns? And then how does the Fed play into this? So then when you look at what has happened with the Fed so far, so the economy is closing on full employment, which again pushes us much closer to the action that the Fed's going to take, which is going to be tightening rates, increasing rates, and you're starting to see that get priced into the market. As we said from the very beginning, it wasn't going to be 50 basis points. It was going to be 25. The market is kind of waffling back and forth between an expectation of 50 and expectation of 25. We still hold to the fact that it's going to be a consistent increase of 25 basis points. Won't spook the market. It's something that is very widely accepted. Nobody would be surprised by seeing it. If anything, the market might actually react positively to it versus where it would be on the 50 basis points. So those are things. But when you look at inflation, which we'll talk about briefly in a moment, and you look at full employment, and those are the two main targets, it would be irresponsible at this point to just not raise rates. And you could make that case that it was irresponsible not to do it earlier, but that's where we sit right now. In the meantime, when you look at the fiscal policy contribution to real GDP, we're in the full point of fiscal drag, where you have the government pulling back, and we'll show some points on where that is. But you see that the government's pulling back, and that's going to create some sort of drag, which will reverberate through the system. The question will be, can that be made up by the consumer, by the rebuild of inventories and some of that investment? And our answer right now is yes, where it will be underwhelming the growth, but it'll still be in positive territory, at least for the next few quarters. We could make a case that you start to see a more aggressive slowdown in Q4 or Q1. I could make a case for either one. I'm not really convinced which one yet. And right now, just based on where the leading indicators are pointing, I would say that becomes a 23 event. But again, we're always looking at the data, always trying to interpret where some of these driving forces will be. And this is going to play a big role at what do rates do. And here you can see that the 30-year is well into the positive territory, while the 10-year is really kind of sucking around this level of negative 54 basis points, which is, again, something that we do think continues to drive higher, where both of the break-evens will then be in positive territory. And when we look at that, we want to look at all of the different entities. Where are the current levels of break-even and what is needed? And when you look at the U.S. break-even at its 2.5%, when you look at the 30-year, it's 2.15, and that's where, right about where it is right now, where the 5-year and 2-year continue to go up, which is where you're starting to get a little bit of a flattener, especially at the front end of the curve, which when you think about typically a flattening and then an inversion becomes a concern. And then typically that is a prelude to a potential recession. And you're starting to see some of these different stress points. So the question will be, where are the stress points and where do the rates go in the near term? And that's when the 10-year is the one that we focus on the most because of emerging markets. And this is where emerging markets typically price themselves off of. So you can see that there's been we've been sucking around this point here. It's the highest that we've been since 2020. And nothing goes up or down in a straight line, obviously, unless you're in the tech sector. But then you can make a case that you do. But here's where you can see that pressure point, where the break-even inflation rate really at that 2.5 as the generic continues to grind higher, which is why we do think that there is a natural trend up into that 2.5% and actually likely closer to 3% by the time we get to the end of the year, especially if the Fed does what we think it's going to do with 3 quick rate hikes, back to back to back, and then a pause, and then one more towards the end of the year, because we do think that Powell is more focused now on where's employment, where's inflation, where's sticky inflation, to be clearer on which part is going to matter most, because we will see some of the softening and adjustments on the flexible side, but that's where they're going to have to get a bit more aggressive and not lose control of rates. Because if you lose control of rates, you could then create a wage spiral, which is something that they're going to look to avoid, and they're willing to sacrifice some employment and create some of this tightening. Now, as you can see here, there is a lot of repo, or the reverse repurchasing facility. As you can see, there is a lot out there. We continue to be right at the near record highs of this $1.6 to $1.7 trillion that are moving back and forth between the Fed. And this is where we continue to see, again, a lot of this liquidity that is going to eventually or need to be pulled out of the market. And here's why. When you look at just the trend of M2 and just the money supply just absolutely exploding in 2020, if anything, they're going to try to get as close as you can to that trend line. And I mean, in an ideal world, they'll go below that trend line, because if you think about every stimulus dollar, when you leave it in the system for too long and then try to do more stimulus on top of it, you take away the impact. And think about, because everyone likes to talk about arrows in their quiver, think about pulling back on a bow. The more money you leave in the system, when you pull back that string, you're not going to get as much of that arrow and how much impact you're going to have. Where the tighter you make it, the more you can pull that back. And when you release more liquidity, when you release more QE, when you do rate cuts, you're going to have way more impact. And that's when you look at China, how China has really failed to raise anything or tighten anything over the last really 10 years. And we'll talk about that in a minute, as we did last week. You minimize what the impacts will be under the law of diminishing returns. And that is, I think, what you're seeing here, and the reason why you need to continue to see this adjust. And it's already being priced in. So when you look at the financial conditions tightening at their fastest pace, measured over 2 months since the pandemic first started, and it's just people prepping for the fact that they're going to tighten, and you're starting to see that move through the system in preparation as you're going to lose mortgage-backed security buying. You're going to see the Fed really back off, and that's starting to create some of this tightness. Now, when you look at funding costs for recent deals, the increase above last year's already high levels. The CLO weighted average cost of capital continued to trend up, and that's something that will continue when you look at these underlying, what is the quality of the deal? Not only that, but also what are the Fed actions going to be? And here's some of the driving pieces. The broad-based inflation, trimmed mean and median metrics tracked by Cleveland Fed and Dallas Fed are surging alongside CPI. So this is where you look at all these underlying pieces. No matter what you strip away, it's the prices are going up. But it's not only just the prices, it's just a lot of these other ones like the median CPI, the 16% trim, the PCE. Those are things that are looking weighted more towards the sticky front. And here you're seeing not only the rate of change, but then the ability for them to remain elevated is one of these driving concerns. And then tying back into segment one with a lot of these increased costs of shipping, transportation costs surging compared with a year ago. Truck shipping cost up 18.3%, ocean freight 29%, air costs 11%, and rail costs 9%. Annual surges have pushed levels to all-time highs, except for air, which is kind of going sideways at this point. But you're getting an idea of where the problems are, and even though things have improved, they're still at a really terrible spot. And that's and by terrible, I just mean in terms of what costs have to be passed on to the consumer as companies also try to manage wage increases as well as what their underlying shipment costs look like. And then when you look at import price, so we continue to import these all imports excluding petroleum. Import prices continue to be at all-time highs, at least going back to 1990. And as we've import a significant amount of our supply chain, this is going to continue to be that driving piece and create this problem on the underlying consumer as companies try to pass those through. And there's a mixture of it, not only just the stuff on the boat that's expensive, but also the boat itself remains expensive, as well as the ability to get it onto a truck, onto a rail car, and into the broader market. And labor costs point to a sharp decline in margins because we're starting to see a bit of a rejection or a hesitancy on the retail side in terms of what they're willing to spend. So as margins go up, you're going to see a drawdown in terms of what those margins will be, because it's going to be limited on what the companies will be able to recover, again, creating some of this tightness at the fundamental level. Now, when you look at U.S. consumer, Google search activity around going out and spending, still in the negative territory, but has turned from the bottom. It's important for three reasons here. One, we had Omicron. That's obviously going to impact some activity. Two, you had seasonality. It was January. It was February. So it's, again, the coldest period of the year. But you're starting to see that turn positive. The question is going to be, how positive does it turn? Or does it stay a bit muted given the fact that there's limited deals and maybe people don't feel as wealthy as they have previously due to inflation, due to slow wages, and that creates some of this underlying strife, which, as you can see here, disposable personal income total, again, has moved negative. It's below that trend line and has continued to trend down, which becomes an underlying problem of, well, how wealthy does someone feel? Do they feel comfortable spending additional dollars as their just general means of activity continue, or cost of living continues to rise? And this is when you look at the mixture of real goods spending in chain dollars has come down as real disposable income also comes down, and they should continue to drift lower. Now, wages coming back up will help insulate some of that. But when you look at the fiscal drag, you've had a lot of people that have purchased some things that they may have needed, that pulls forward some of that activity. So even if the income gets a bit better, it doesn't mean that you're going to get the same type of spending as you would have just because people have already spent on goods. Services will continue to get better, as we've talked about previously, but the goods side will continue to get a bit softer. Now, this is when you look at real retail sales, we've gotten some of this bounce, which just means that you've absorbed some of the increase in prices, but not all of it, because you're still off highs. And we think this is going to move back below the trend line, as we showed in the previous slide. And part of the reason, when you look at government transfers, is poverty spiking again with the disappearance of U.S. monthly tax credit payments. The U.S. child poverty rate increased to 17% in January, which is the highest level since the start of 2020. As that that child tax credit expired. And that's, again, some of these other pressure points where, as that money disappears, that's, again, people feeling not as wealthy, the inability to spend, especially as their prices continue to rise, in their just general living wages, in living expenses. And then when you look at revenue growth is set to start to fall as new orders to inventory ratios moved lower. The S&P revenue per share is going to come down. Now we're starting to see that new orders flatline and come back up. And that's where, as we've said before, it's going to be a meet in the middle. It's not going to be this huge surge up or down, but more of a gradual move. And you can see how disoriented or the alligator mouth, if you will, that has been created by the movement on both sides. So then when you look at U.S. supply shortages still easing from summer stress, we're coming off the highs, but when you go back through history, we're still high. And if you were to take away the recent peak, we're still at all-time highs. So even though things have improved, there's still problems, and it's not getting any better, which is why we think that you get this kind of flatlining, and that's going to result in additional pricing remaining elevated throughout the remainder of this, really the end of this year, but we'll see how that continues to adjust. Now, you had a nice jump in the preliminary Fed manufacturing at 57.5 versus the estimate versus 55.5 in Jan. Services were up to 56.7 versus 51.2, bringing the composite to 56. January sales boosted by fading effects of the pandemic. Global shortages of materials are still affecting input prices. So when you look at input prices paid still much higher. You have the supply chain getting a bit better, but still elevated. But when you look at some of the other pieces, there are some leading indicators that are getting better. The supply constraints also contributed to a further marked increase in firms' costs, which rose yet again at another near record pace in February. Increasing number of companies sought to pass these higher costs on to customers, resulting in the largest increase in average prices charged yet recorded by the survey. So they're still trying to pass that on, and the question will be, where does the consumer reject it? And based on some of the previous points, we think that's already begun and will only get worse, which again leads to what that activity is going to look like as we go into what is normally a rejuvenating period in spring. How will it be below seasonal norms? And the answer, in my opinion, is yes. Now, when you look at some of the leading indicators, Philly Fed Index came down, pointing to some of this capacity of the ISM. But one of the things is Philly Fed is regional. So it does have some predictive capacity, but there's a lot of reasons why the Philly Fed could come down a bit and ISM could just flatline. And we think here that the ISM is more likely to flatline and actually go back up. Some of it due to positive contributors like new export orders, new orders in general, as well as some of the negative side of increased prices and increased delivery delays. But these are some of the different pieces that we want to talk about here. So when you look at Philly manufacturing, employee work week came down, still positive, but again, starting to normalize. But prices paid remaining elevated. And again, this is going to be how much of this can they pass through, which leads to how much can the consumer absorb as we continue to show that wages aren't keeping up, real income is falling, and that becomes a bigger problem. And then when you look at the market manufacturing PMI, you're still off the highs, but bouncing around. New export orders, which is a big leading indicator, nice bounce, which again is supportive of where we're going to be going into March. And it's in line with the fact that you've had a little bit of a catch up on some of the deliveries. And so as you take delivery of what you've been waiting for, you can go out and get new export orders. Service PMI expected at 53, came in at 56.7. A nice bounce. A lot of that was driven by prices charged. Prices charged continue to surge. I know all of our costs on the service side have just continued to explode. It seems like it goes up every time we go to the store or we go to a particular service. But again, you're continuing to see this get passed on. But then when you look at manufacturing, input prices came down a bit. When you zoom out, you can see that it's still elevated, but they're still trying to recover some of that price with output prices remaining near all-time highs. And we're starting to see input prices come up a bit, and they're going to try to keep these output prices at the elevated level, which is going to soften some of that those leading benefits. But again, still a positive, still in the right direction, which is going to keep us growing. And a lot of that is because the backlog of work has come down. So future output should increase because new export orders have increased. Backlog has come down, which is going to keep things a bit more active and is a bit more on the positive side of where this is going to go. So now that we've looked at that, in the next segment, we're going to go a bit deeper into the U.S. consumer and how some of these leading indicators are good and bad for them, and where we see the consumer shaking out as we go through the remainder, or really as we go into a key spending period of both spring and summer.